Hi believers, this is Amit from Via Team. It was one of the tough weeks of 2025 for Indian equities, with Nifty losing around 2.7%, Bank Nifty losing around 2%. The real pain, however, was in the broader market, where the Nifty midcap and small cap indices plunged nearly 5%. The week began with a shocker from Trump administration imposing a sharp hike in H-1B visa, which dampened sentiments in IT stocks. Week ended with another blow of 100% tariff on branded and patented pharma products, leaving pharma counters in the ICU. While the immediate impact of these developments on Indian IT and pharma companies may be limited, the outlook has turned uncertain and sentimentally it is negative. However, it's important to clear the air and present an accurate analysis of the situation. We are estimating a negligible impact on the Indian pharma companies from Trump's pharma tariffs. Given the duties announced are on branded and patented drugs, there would be no impact on the generic exports done by Indian pharma companies. The major portion of exports to the US is generic medicine. So we believe it is business as usual for generic pharma companies. India mainly exports generic drugs to US, and just around 3% of the net drug export from India to US would fall under the conditional Trump's pharma tariff. Also, CDMO companies cater to the global requirement of innovative pharma companies and not just the US market. Hence, fall in pharma stocks were completely unwarranted and they might see renewed buying soon. However, market sentiments are just in a poor state. Coming to the domestic economy, the Reserve Bank of India Monetary Policy Committee meeting is set to begin its 3-day get-together from September 29th. As per the RBI FY26 schedule, this will mark the fourth MPC meeting for this year. We believe a 25 basis cut at the upcoming MPC meeting would be a timely and practical step for the governor to support the credit growth to strengthen the lending ecosystem across banks, NBFCs, and fintech companies. Inflation has dropped sharply, with SBI research projecting CPI near 1.1% in October, and the new GST rules implemented on September 22nd already reducing tax rates on many goods and services. Together, these factors give the RBI room to ease policy without risking price stability. On trade deal with US, Indian officials had a very constructive discussion with US counterparts during the visit to Washington past week, with both nations agreeing to carry on talks to finalize a mutually beneficial trade agreement in the near future. Trade deal related uncertainty is causing FIIs outflows from India and keeping our market in distressful situation. Adding to the uncertainty, US Federal Reserve Chair Jerome Powell earlier this week hinted a cautious stand on the future rate cuts. Hence, if you see, last week even the US market was down. Accenture weak guidance in its Q4 results also aided the negative sentiment. If we look at the trend of the FPI activity in India, there are important phases. In the first 3 months of 2025, the foreign investors were sellers. In the next 3 months, they turned buyers. In the last 3 months, means July, August, September so far, they have again turned sellers. The stop-start trend highlights the lack of sustained conviction among foreign investors and suggests that Indian markets may continue to witness bouts of volatility until clarity emerges on the global interest rate and domestic earning momentum. On the technical front, sustained weakness in the heavyweights has accelerated index decline, with the Nifty now approaching its 200-day moving average near 24,400. The sharp correction in mid-cap and small-cap index has further dampened sentiments as both indices are also hovering around their respective long-term averages. From here, selling pressure may ease and selective buying could emerge subject to news flows, but the broader uptrend to resume the Nifty must decisively reclaim the 25,000 mark. Concluding, the main reason for the weakness are tariff wars and ongoing corporate earnings slowdown. The new corporate earnings season will start in 3 weeks. Any signs of flat or deteriorating earnings may lead to us transitioning from consolidating market to a corrective market. Further, a resolution on tariff needs to be reached for markets to stabilize and bull spirits to return. Given this backdrop, we recommend adopting a cautious approach for a while, focusing on fundamentally strong stocks and adding in a very staggered approach. Normally, the stagger approach is to have 2 to 3 buys in this market, but seeing the situation, we recommend to spread the entire buy in 5 sprints. Means if you want to buy a stock for a long term, buy in 5 chunks to average out better. Avoid aggressive directional bets until clear signal emerges. That's all for today. Thank you so much.